as they've grown, and a number of them have grown, finding areas to deploy that capital has become hard.
More broadly about the industry, why are SMAs becoming so popular? Why are external allocations becoming so popular? I see it in the news all the time. What's the context?
Yeah, I don't. I feel like people always they say this time is different. So I don't think this time is much different. Mark Twain, so history doesn't repeat itself, but it rhymes a little bit. I'm dating myself, but I remember pre-crisis that separately managed accounts were quite popular. I worked at a previous shop, InvestCorp. We had a large fund-of-fund platform. A big portion of our fund-of-funds were managed through separately managed accounts. We wrote lots of white papers on the benefits of using separately managed accounts. Perhaps they went out of vogue a little bit post global financial crisis. Hedge fund allocations came down a bit. I think the general idea of separately managed accounts isn't new. I think the way that folks are going about implementing them, using them, is different. So historically, separately managed accounts would be, I'm a large pension plan, I have a large allocation, I would like my own separate vehicle because it's large, and perhaps there are some terms associated with this vehicle, perhaps there's some liquidity, whatever the case may be, the special terms. And that's historically, they're designed to be these bespoke vehicles for institutions. Now, I think this is where you're going with the question is, I think there are separately managed accounts that happen in that space, but increasingly there are separately managed accounts that are housed within existing investment managers. I think in the multi-strategy space, and it's been well documented, this war for talent, there seems to be increased competition. As our competition has increased over time, I think finding unique strategies has been more challenging. So I think a lot of kind of multi-strats and some fund-of-funds are opening themselves up to allocating externally to other managers in a way that feels very familiar, in a way that feels like an allocation that you would make to a pod by using these separately managed account vehicles. I think that's what's different, kind of the use of it. I don't know if the structure itself is new at all. I think it's just a continuation or evolution of kind of on a path that we've been on for a long time.
Yes, and I guess to go deeper into the story, why is it now specifically the multi-strat funds that are, I guess, doing this sort of thing when before it was different group of investors?
I suspect it goes back to where we hear anecdotally just getting access to talent, right? The multi-strats have done a great job on their branding. They've done a decent job on their sales. They've raised a fair amount of capital. The capital they've raised, they've been able to do, generally speaking, done a good job of generating positive returns. So they've grown. As they've grown, and a number of them have grown, finding areas to deploy that capital has become hard. If you're going out and trying to find folks that are spinning out of banks or other hedge funds, that increasingly becomes harder and harder to do. When there are, small and mid-sized funds that perhaps have been running strategies, maybe they haven't done a great job on their branding and marketing. They haven't been able to grow as much as the multi-strats have, but they still offer compelling return streams and really interesting risk characteristics. Why not allocate to those things by way of a separately managed account and maintain some of the control, the structure and control and transparency that you have with your other pods? I think it's just a natural growth of the business and growth of kind of that space for that to occur.
What makes the multi-strat funds special in that they're able to do this? Clearly, they're allocating to firms that are smaller, mid-sized funds who theoretically could raise the same amount of money from the LPs of the multi-managers. But the multi-managers, because their brands are so good, because they've built such businesses with an insane moat, with all these different sources of alpha, all mostly uncorrelated. Obviously, there's some debate around that. How are they able to do it? It seems ridiculous that these funds can get so big gobble up all the talent, pay managers hundreds of millions of dollars a year. Why? How?
So that I don't know. No, okay, yes, so I don't know how their compensation structure. I can't opine on.
Yeah, no, and by the way, like the hundreds of millions is just from like articles, right? That's just public domain stuff.
Yeah,
I am a podcaster. I have
So
knowledge.
And they're not paying us that, certainly. So so I don't know of kind of that aspect of it. I think where they've been successful is if I'm an allocator and I have limited resources, and I'm a pension plan. I have a team of 20 people. I have like 4 or 5 people covering hedge funds. And in addition to the hedge fund responsibilities, they're also covering long-only equities, and maybe they're doing another asset class. So limited hours in a day. If I want to get an exposure to something that's different than my fixed income, maybe credit, and I want it to be liquid, these things called hedge funds are pretty interesting. I could build my own hedge fund portfolio, bespoke of individual managers, and I'm evaluating 10 long-short managers, 10 credit managers, 10 fixed some, so on and so forth. That requires hundreds of man hours, and I'm not saying that folks are not doing that. They clearly are. But if I can find a solution that provides me diversified exposure across a number of different asset classes and strategies, gives me a return stream that's compelling and differentiated from the other things I have in my portfolio, it's reasonably liquid. That's changing, clearly, but historically kind of liquid, more liquid than, say, private equity. I like that. If that manager's been around a long time and they have an institutional infrastructure and institutional client base, that's a pretty compelling argument that I can make in front of my investment committee and my board. I can see why folks allocate to them, and it makes sense. If I'm a single strategy hedge fund and, say I'm long short credit and that's all I do, it's a hard to sell naturally, because you're just not as diversifying. You have to find folks that are looking for that sort of exposure. If somebody's looking for a diversified hedge fund exposure, which a lot of people are, having a kind of core allocation to a multi-strat that gives you that, or a couple multi-strats that gives you that, and then finding bespoke solutions here and there, I think that's an approach a lot of investors have taken. And again, this is not necessarily new. I think, back in the early 2000s, the fund of funds played that role. So people had allocations to kind of large fund of funds that give you diversified exposure. That's changed a bit, and where that diversified exposure today is coming from the multi-strats, but it was similar, right? The mechanisms are different and the execution was a lot different, but it was similar in terms of, from the allocator's perspective, having this core diversifying exposure to liquid alternative hedge funds and then doing things around the side.
I think there's also a lot of talk, and I think about this a lot, of how well the multi-strat, multi-manager businesses are run. I think you mentioned the general way to package a product and the general things they look for is they have a very strong understanding of the risk profile and how each individual strategy can fit into the broader portfolio. And I think, I've attended a Ken Griffin talk once when I was studying in London. He says the same thing in every talk. Talks about recruiting the most talented people, and that at Citadel they try to do that. And I think that these businesses, these CEOs, in terms of understanding the asset management game and building businesses with extremely strong moats that are resilient, they're unmatched. Not speculating, but just from what you've seen, what makes a great hedge fund operator, manager? What would you bucket the skill sets into? And what do you think, if you can, or if you don't know, that's fun too as well. What do you think makes these businesses robust and profitable?
Yeah. I'm going to go back to this branding thing. The fact that you mentioned you went to Ken Griffin, you've seen him speak a couple of times. He says the same thing over and over again, and you actually remember that. That's great, right? That's actually evokes an emotion. So I think going back to that, somebody like Ken Griffin, I don't know him at all, but he has a very strong brand, and he has this message. And this message, if you like him, you tell that story. Just like you told me that, like you said, the story. You're not the first person that's told me this story, right? So I've heard this story over again. That's powerful. I think that's key to make your business resilient. Going back to this branding mechanism, I think managing people, that's both art and science. And when you have these large, disparate organizations that are today are global, with managers and pods all around the world, being able to manage that in a thoughtful way and having the technology infrastructure to do that in a cohesive way is important. Trading execution, without getting the words, get into weeds of this, I think a lot of the multi-strats have done a phenomenal job of managing their trades, executing trades and financing and developing relationships with their counterparties that are favorable to their clients. I think that's done a great job. And the end result, we talked about risk and exposures. I think they've done a great job of managing risk and exposures over time, and it's been quite resilient. They've been tested across a number of different crisis type periods, and they've generally proven to be quite additive to people's portfolios.
I think I read an article recently from 2008. It was someone talking about an article from 2008 that enlisted Citadel as one of the hedge funds most likely to collapse during the Great Financial Crisis. And Ken Griffin talks about this. What makes an asset management business, a hedge fund business, robust? And I asked that question with the context of knowing that it's not just about returns. I think AQR, before called this year or last year, didn't have the easiest group of years. They weren't performing. And yet, as a business, they're robust. They've held strong. What are the things that make a MOTI hedge fund business?
Yeah. So I think why folks invest in a hedge fund is to buy stream returns and some protection on their capital, and hopefully that stream returns is diversifying. I think making sure that you articulate what that stream returns is, being brutally honest about kind of the risk you're assuming, and really having an open dialogue with your underlying investor base about what you do. So
real quick, what happens if you're not honest? So
yeah,
I feel like there might be a temptation for a fund manager to pitch to an allocator and say, our stream of returns, here's how we make it. But then they make it in a different way. What happens in that case?
So that's what I was getting at. So I think that's very dangerous. So I think during those periods of uncertainty that every strategy will go through, inevitably, if it's not clear to the investor why the portfolio is behaving the way it is, that's a reason to pull your capital, right? And I think most investors understand market variance, understand cycles. But if you've articulated that I'm going to do well during periods of heightened dispersion, and there's a period of heightened dispersion, and you tank, that's going to be challenging for investors to understand why that might be the case, right? So I think those type of conversations around really articulating what are your exposures, how you generate returns, what are the risks you're assuming, is helpful to make them understand kind of when you might not do well. So in the strategy that will do well in periods of heightened dispersion, if there's an extended period of no dispersion at all and you're not performing well, I think an investor can understand that. As long as you do well or do somewhat well during those periods of increased dispersion. Now, the inverse is true. People are going to be upset. Rightfully so.
And so would you say that building a successful hedge fund is just as much about communicating very, very clearly with your investors and making sure that your capital base is robust as it is focusing on returns?
100%. Yeah. So that's what I was, when I talked about, that's what I was alluding to with regards to this raising capital. Retaining capital is the same as raising capital, but this capital preservation and raising capital is probably the hardest and most important part of the business. That's what I was alluding to. When I was talking about the brand and how people feel and the emotion it evokes, I was describing kind of that story. There's a story around how you generate returns. There's a story a true story, not a novel. We're talking about it like a documentary about your process, a story that you're articulating that should be a part of your voice, that shouldn't be left for the investor to conjure on his own. It should be something that you're articulating and that they understand will help you through those more challenging periods. Because the story is true. The story will resonate. The story will have these paths and peaks and valleys. That's going to happen. Articulate that. That's part of your brand.
Last question. We've talked about a lot from, you started talking about the allocation you got from a multi-manager, raising $500 million. Talked about what makes a hedge fund business robust. Also talked a bit about your event-driven strategy, which you raised money for. You're very unique in that you're a partner at a quant fund, and but your focus is much more so on capital raising, less so on research. And so I think you see things from a very different angle. If there's a manager watching right now, maybe they're doing some things well, maybe they're not. But what is the number one mistake that you see managers make over and over again? Can be with regards to strategy, can be with regards to raising money, can be with regards to retaining money. One thing, what is it?
Yeah, I think my observation of some managers is trying to conform to some mean. So trying to articulate yourself like everybody else. And what I was getting at, using these buzzwords like correlation or AI, doing the thing that everybody else is doing in order to kind of fit in a box, is a problem. Because, again, from the allocator's perspective, if they hear that and you're in a box with everybody else, they're just going to allocate to the guy who they've known for last 20 years and not to you, because you sound just like the guy I knew for 20 years. Now, if you sound a little different than the other guy and your returns are better, all right, that's an interesting story. But if you sound the same and your returns are a little better, then no, I'm not going to take that gamble.
I love that. Sell a differentiated product. You just might make money.
Maybe.